All right, welcome to another explainer. Today we're going to look way past the clever marketing campaigns, the flashy product launches, and those highly charismatic CEOs to really examine the secret engine that actually makes companies run. It's kind of like the hidden machinery that turns a great idea in a dusty garage into a sprawling global empire. It's this completely invisible force, but man, without it, the whole system literally grinds to a halt. I mean, have you ever wondered how businesses actually survive and grow in such a cutthroat environment? You see these companies launching massive new products, expanding into totally new countries, or dropping literally billions to buy out their biggest competitors. And you really just have to ask, what is fueling all this frantic activity? How do they confidently make these high-stakes decisions when just one wrong move could sink the entire ship? Well, the ultimate answer, the absolute lifeline of any enterprise, big or small, is business finance. Okay, let's dive right into this. At its absolute core, business finance is simply money management. It's how a company earns, spends, invests, and grows its cash. But let's elevate that for a second. We are definitely not talking about a static pile of money just sitting safely in some bank vault gathering dust. No way. We're talking about a dynamic, living, breathing system. It's this high-stakes art and science of making absolutely sure that the cash flowing in always outpaces the cash burning out. It's about making strategic plays that turn today's profits into tomorrow's total market dominance. So every business, from a local corner boutique to a massive global tech giant, has to navigate three critical capital phases. And honestly, each one has its own deadly pitfalls. First up is startup capital. This is your ground zero money. It's just what you need to build that initial prototype and, rent a desk. Next comes working capital. Mismanaging this one? Yeah, that is the silent killer of great ideas. It's the everyday fuel to keep the lights on, buy inventory, and make payroll so your team doesn't just up and walk out. And finally, there's expansion capital. This is the rocket fuel you need to scale up, acquire competitors, and open new branches. It's just this constant, grueling journey from starting to surviving to ultimately scaling. So, where does all that capital actually come from? Well, businesses generally have two main arenas to pull from, and founders are basically constantly weighing them against each other in this high-stakes chess match. On one side, you've got internal finance. This is reinvesting your own hard-earned profits, tapping into your reserves, or liquidating assets. It's incredibly safe, and you answer to absolutely no one, but it is strictly limited by what you already have in the bank. On the other side is external finance. Think massive bank loans, issuing shares, or pitching to venture capitalists. You get access to jaw-dropping amounts of cash to grow incredibly rapidly, but the catch is you invite very powerful outside forces straight into your boardroom. Now, what's really interesting here is that choosing between that internal and external money basically hinges on a delicate and honestly sometimes agonizing balancing act of three key factors. First, amount. Like exactly how much cash is required to actually pull off your strategy. Second, time. Is this just a quick, short-term fix to cover payroll, or are we talking about a decade-long investment in a massive new factory? And third, which is usually the most deeply personal choice for any founder, control. Securing $10 million from an outside investor sounds like an absolute dream come true, right? Well, until you realize you're giving up a massive chunk of your company and suddenly someone else has the voting power to literally fire you from the business you built. It's an incredibly delicate trade-off. Let's try to bring this abstract stuff down to earth a bit. Imagine a highly successful local bakery. The artisan pastries are incredible, there's a line around the block every single morning, and they've totally crushed the startup and working capital phases we talked about earlier. They are absolutely thriving. But now, they're standing squarely in the expansion phase. To meet this massive demand and, say, maybe open a second location, they urgently need to buy a whole suite of massive, industrial-grade ovens. The stakes are very real here. So how do they navigate that decision matrix we just looked at to make this leap happen? Here is the agonizing dilemma weighing on that bakery owner right now. They could just walk straight into a commercial bank, secure a hefty loan, and buy those shiny new ovens today. Boom, they keep 100% control of their beloved bakery. But on the flip side, they immediately take on a heavy, stressful chain of debt with fixed monthly payments, regardless of whether pastry sales take a dip. Alternatively, they could just patiently use their existing profits. No debt, total independence, complete peace of mind. But the catch, they can only expand as fast as their current savings actually allow, which might just give a rival bakery enough time to completely steal their market share. Amount, time, and control. Which path would you choose? So, the crucial point is that ultimately all of this boils down to a brilliantly simple equation: finance equals survival plus growth. It is just so much more than staring at dry spreadsheets in some dimly lit back office. It is the vital, pulsing energy that dictates whether a business merely scrapes by to survive another turbulent, unpredictable year, or whether it harnesses that energy to transform into a towering success. Without mastering this lifeline, even the most brilliant, absolutely world changing idea will simply run out of oxygen and fade away. So, if you're building something right now, or maybe planning to in the future, you have to ask yourself a pretty tough question. Will your financial lifeline lead to a towering skyscraper, or will a single miscalculation force you to close your doors for good? Understanding the underlying mechanics of money isn't just for the accountants. It is exactly what separates the dreamers from the absolute titans of industry. I really hope this explainer gave you a powerful new lens to view the business world around you. Thanks so much for learning with me today, and we'll see you in the next one.